And we're live, traders. Welcome back to another episode in the System Development Series. Today we've got a very, very special episode. It's all about tying together everything we've learned so far and actually applying it to the charts in real time. We are going to backtest a system live for you today. We've got a couple of examples we're going to take you through. We've got a whole set of rules. We've got the charts ready to go. We've got spreadsheets ready to go. This is one that you cannot afford to miss. Now, before we get started, a couple of things to get out of the way. If you're watching this series from episode 5, obviously you appreciate it's been 4 episodes before it. I would always try to recommend to watch this series in order. In the top right hand side right now, you are going to see episode 1. If you're joining us this part of the series, thank you for joining us number 1, but please make sure you're trying to watch this in order, otherwise it might not make a lot of sense to you. As always, today I'm joined by Cass from CDFX Trading. Cass, say hello.
What's up, guys?
And without further ado, let's get into the presentation. Now, as you know by now, we always start with a very boring disclaimer. If you want to pause the video right now, you're very welcome to and read what's on the screen. But in short terms, neither me or Cass are financial advisors. We are purely providing this content for educational purposes. If you make money in the market, that is your responsibility. If you lose money in the market, that is also your responsibility. So let's keep things moving. Let's get into the presentation. Now, the way we're going to do this today, you've noticed already that Cass has basically said a word because I'm going to take care of the slides today. We're actually going to move over to the charts after this slide, so bear with us. And we're going to start testing a fully mechanical system. Now, what that means is we've got a system set up and ready to go. We've got a set of rules that we're ready to test with you today. We've got a couple of different examples. Mechanical meaning it's not discretionary at all. We've got rules, very black and white things that need to be met to take a trade. We're going to test that version of a system, and Cass will take care of that in just one moment. And after that, we're actually going to test a systematic system with a bit of a discretion. So that will all become very clear what that means and the differences between the two very shortly. But that is going to be a systematic system with a little bit of trader discretion that you're going to apply with a little bit of knowledge behind it and that experience coming through. And of course, at the very end, we're going to have a recap and preview. So today is going to be so much value. We're going to tie everything together. I think without further ado, we're going to jump over the charts right now, and Cass is going to take it away.
All right, we are at the slides right now at the Excel sheet, and today we want to show you how to backtest 2 different types of systems. And we want to show you 2 types of systems because one system is fully mechanical and one has a bit of discretion in a systematic way. But the difference is that the systematic approach with the discretion has to be tested in a different way in order to have reliable results. We are going to start with the mechanical system, which you are looking at right now. I always start with writing down the rules. And in previous session, we've talked about choosing concepts. So you start with the concepts and then you start by building rules around it. So let's dive into strategy number 1. I just named it. You can name your strategy whatever you want, of course. But this is a pin bar reversal Bollinger Band. It's going to be tested on the 4-hour time frame. The data also very important. This one is Hugo's way. Again, choose whatever platform you want to use. Write down the pair you're going to test and then write down the rules. And the rules are very, very important. They need to be, especially with a mechanical system, as black and white as possible. Otherwise, testing will be very, very hard to do so. So let's dive into the rules for the bullish setup. A pin bar has to form at, so touching, or below the lower Bollinger Band with standard settings. The next thing is the pin bar is defined as a body in the upper half of the candle, and the wick has to be 2 times as long as the body. So as you can see right now, we know exactly what a pin bar is. We have defined it. There is no guesswork. It's either a pin bar or it's not a pin bar. And that way you can objectively test something. The next thing we did is we basically define a location where we want to see it, because often a candlestick pattern or any other type of trading idea on its own might have a slight edge, but it's often the context and the location that increase its performance. So we know what we're looking for and we know at what location we're looking for it. Next thing is the stop loss placement. So the stop loss is always based on where you are wrong on your trading idea. It's not based on the amount of money you want to lose. It's not based on your risk reward ratio that you want to fit onto the market, because I see that so many times it's based on where your trade idea is wrong. And in this case, the idea is wrong if price moves back below the low of the pin bar. So that's where the stop loss is. Now, as you look at the target, we have static targets, and that's usually how I approach my testing when I do mechanical trading. And static targets basically mean a 1R, a 2R, and a 3R target. So it's not based on market structure, indicators, or whatever else. I just start with very basic targets to see if there's any edge there. For the bearish setup, it's basically the other way around. So the pin bar is at the upper Bollinger Band and the body has to be in a lower half, etc. Not going over it, you can read it right here, and it all makes sense. So let's dive into the charts right now.
This is where it's all going to be sort of tied together. If you wonder what a Bollinger Band is, just to let you know, it's a type of indicator. You see it on the chart right now. You've got that middle line, you've got two sort of bands around it. That is what we call a Bollinger Band. I don't want to go too much into detail about indicators and Bollinger Bands and all that sort of stuff, but if you're wondering, that's exactly what that is. Cass, take it away. Where were you?
Yeah. So let's start with looking at the setup. So the way I do this when I have a mechanical setup, you don't have to replay the entire market because there is no discretion. We know what a pin bar is, and if I just replay the market, this pin bar will look exactly the same. So it doesn't make sense to use a replay mode. And that's the massive difference between a bit of discretion and mechanical systems. With mechanical systems, you can just go back over the charts and highlight it. But if you would do that with a bit more of a discretionary approach, you're just trading with hindsight bias and your results won't be accurate. So let's take a look at this. I've already highlighted some setups. So for example, this is a bearish one. As you can see, it touched the upper line of the Bollinger Band. We've got a body that's smaller than, basically the wick has to be 2 times larger than the body, which is definitely the case, and the body is in the lower half. Stop loss goes above. I've modified the Fibonacci tool to basically call it the stop loss. You can do that by changing this over here. A lot of people don't know that, but
do you know what? I didn't know that. That's actually really interesting. I'm learning something as well.
Let me quickly explain it. So the 0 line is the stop loss. 1 is where I enter. The entry is always at the close of the candle, and then 2 is going to be 1R, 3, 2R, etc. So that makes it very easy to test different targets. I'm surprised no one knows that.
No, I didn't know that actually. That's really interesting. I've always been doing it manually and trying to line it up on the side of the chart. So at least I'm learning something today as well. So there you go.
Good stuff. So entry on the close, we've confirmed a sell setup, and then we want to basically fill in if the different targets got hit. So we can see 1R got hit, 2R got hit. This is 3R. And it didn't get hit before the stop loss got taken out. So let's dive into the sheet. I usually do is by just putting a Y. And then at the end, you can basically calculate how many Ys you have. You can calculate your win rate, your R, etc. But it all starts very basic. Here, of course, and no. These are 2 very important metrics you can track as well. I usually start with the basics. These 2 things basically mean the MFE is the maximal favorable excursion, which means how far did price travel before hitting your stop loss without taking profits on it. So for example, on this trade, price almost touched 3R. So you can measure it, but it looks like it's around 2.95 R. And then you can note it down here as well. You can do it in terms of pips, percentage. I usually do it in terms of R. And what that does is, let's say you have tested 100 trades and you see that the MFE is, for example, on average 2.5. In that case, it doesn't make sense to take profits at 1R because you know that on average, most of the trades hit 2.5R or anywhere in that area. And from that data, you can start testing different targets. Same with the MAE. It's the other way around. It measures how far price goes towards your stop loss before hitting your target. And that way you can see, let's say price always moves 50% against you. Then you can either enter later at a better price. Let's say price only moves 10% against you and then goes into profit. That way you can decrease your stop loss size, and that way you increase your risk reward. So these are two important things you can track. Again, you can do it in terms of R, pips, percentage, whatever you want. And then also I've written down here some things you can test as well. Not going over that today because that will take so much time and it's different for everyone else. But you can also test confluences, at what time of the day the setup works best, etc. Again, it's up to you. I first start the basics, and if I don't see any clear sign of edge there, I usually don't even bother with the filters because I want to see a clear edge from the beginning. So let's go to another example. As you can see here, pin bar forming at the lower Bollinger Band. We've got the body definitely small enough to fit the rules. As you can see, for the bullish setup, the wick has to be 2 times as long as the body, which is the case, and the body is in the upper half of the entire candle. Entry at the close of the candle, and as you can see, we hit stop loss without hitting a target.
Okay, I'm seeing this is all put together now. I think it's really interesting how you just mentioned as well, like, it's important to do the, before you drill down into the very molecular stuff and changing the time frame and changing the currency pair you're testing things on, to understand, like, if there's any edge there in the first place. Like, you don't want to throw everything at it, you know, spend so much time on one concept just to realize that it never worked in the first place. So I think you need to have a quite systematic approach in the sense that do the, not the minimum, but do the sort of periphery first, test the rule in a very simple way, one currency pair, one time frame, and just see if it's actually got any potential to go further. Because you can see here, the first trade was a good one. Second trade, you know, it was a stop. We hit your stop loss, but who knows what's going to happen in the future? So you have to have a point within your back testing where you say to yourself, okay, enough is enough now, or okay, this is looking promising. Let's drill down to this further. Let's test further confluences. Let's test the combination of indicators. What happens if I use this Bollinger Band rule in combination with something else? Things can get quite complicated that way, but obviously at the end of the day, we're trying to make the most profitable system possible. So if it becomes complicated, then so be it. So, but interesting how you mentioned that. I'll let you carry on.
Yeah, for sure. So let's fill in the third trade. As you can see, again, pin bar forming, body is small, it's in the upper half. So we enter at the close. Keep in mind, this is a bearish candle, so your close is at the lower part of the body and not the upper part. Also, when I'm backtesting and I'm done, I usually do it a few times over to make sure I haven't made any mistakes. Otherwise, your data is also quite useless. So as you can see, we made 2R, we didn't make 3R. So you fill it in again and you basically get the point right now. So this is how you can test a mechanical system. And you might be thinking, this is just a candlestick setup. What's the point of that? There's no real thing behind it. But the point is, let's say after you've done 100, 200 trades, and you notice that, for example, if you target 1R, you have a 60% win rate. Now that's a small edge. And even if you're not going to trade it this systematic way, you can also use it as a guideline. So let's say there was indeed a 60% chance of hitting this based on your back testing before taking out this high. Then if you're more of a discretionary trader, you can, for example, go to the lower time frames, search for an entry on the lower time frames, and then use this target because you know this target is likely to get hit before taking out the high. So you have a bit more certainty. So you don't have to trade it this mechanical approach. I like to do that. But if you have some real data based on a mechanical setup, you can definitely use it to even improve your discretionary methods of trading. Let's say you want to enter at market structure that's over here. On the lower time frames, for example, then you can see you almost make you make around 2.8R on the same setup, just because you added a bit more discretion. But it all starts with the mechanical basis and the statistics you gather. So I'm not going to do 10, 20, 30 trades. You get the point right now of how to test a mechanical setup. Here you can see some data I filled in. Some very basic formulas. You can do this as well. It basically calculates your win rate, those type of things. So sample size is 3 right now, and as you can see, win rate is this because it's 2 divided by 3, etc. Very basic maths. You can do it as well. And that's how you can start testing your own mechanical system.
And before we move on to the sort of discretionary version of the system, excuse me, I want to mention as well, like the spreadsheet you've got in front of you is just dead simple. Like I think a lot of people, when they hear the word spreadsheet, they're a bit concerned because they don't understand formulas and stuff like that. But you can see here that Cass has written a lot of this in himself. It hasn't taken an awful amount of time just to fill this in as he goes. So you can see that you don't need to have a PhD in statistics to understand how to use a spreadsheet and how simple it can be. My spreadsheet uses a lot of formulas because I'm a bit further down the road of backtesting, and obviously I want to streamline it as much as possible. But when you start out, you will pick up some knowledge as you go. Of course you will. But the important thing is you don't need to have a massively complicated spreadsheet. Just fill it in all manually. It doesn't take long. So you can see Cass's example here. But yeah, let's keep things moving into the discretionary version, I suppose.
Yeah, I totally agree with you. My spreadsheets right now look very complicated, but when I started backtesting, it was just like this and even more simple. So just get started with it. And like Christian says, just when you're doing the process, you will learn and you adapt and your spreadsheets will look better and more sophisticated.
That's just get started. Literally simple as that.
Yes.
Just get started and the rest, if you put the ball in motion and the rest will come in time. Just get started. Don't give yourself an excuse not to really try your best with this, because you will pick up the knowledge in time, but it doesn't have to be very complicated. Whatever suits you. If you want to go down the route of formulas and stuff like that, great. That's, I think, where me and Kat have gone with this over years of trying this method and trying to streamline this backtesting process to speed it up as much as possible. But at the end of the day, do whatever works for you. But you will build knowledge as you move on. Just like everything else in life, put the practice in, you're going to get better. So yeah.
Yep. All right, so let's go to the next system. And this one is going to be a bit more complicated in terms of testing, but still it's very useful to do so. So when you're going to backtest, really think about if the rules are fully mechanical or not. Are they programmable or not? If they are programmable, use the first approach. If it's not the case, if there's even a bit of discretion there, go for the second approach I'm going to discuss right now. And it's very important because your data will be absolutely useless. I've been there before. I thought I had mechanical rules, but the only thing I did was hindsight trading, and it's just not worth it. So let's go to the charts first. Let's see. Yeah, so this setup is going to be a daily pin bar retracement entry. Again, written down a time frame, data and pair. Bullish setup, a pin bar. Let's first define the pin bar. The body is in the upper half and the wick is 2 times as long as the body. Basically the same rules as with the first strategy, so that keeps it simple. Next point, stop below the low of the pin bar, entry on a retracement of structure, static target based on the D1 pin bar. Now this is where things become a bit more complicated, because what's a retracement of structure? And that's why you need to do this on a simulation. That's why you can't go back over the charts, because you can be like, oh, this is structure here, or this is structure there, and it just doesn't work. So first of all, if you're going to use this, define what is structure for you and really make it clear. I haven't made it that clear in this example, but think about it. What is structure to you, and write it down. Bearish setup, of course, the other way around. Yeah, so let's show you a few examples of this particular strategy. I've highlighted a pin bar on the daily time frame. Again, no indicators here like we had in the previous strategy, just a daily pin bar. You can see wick is 2 times as long, body in the lower half. As for target, it's a 1R based on the daily pin bar. So it's basically the same distance as from the stop loss to the close. That's the target we're going to test. Again, it's just a rule I made up. It's very easy to test. All depends on how you want to test your own strategy. So that's the target. Now, let's see. So we're going to enter on a retracement of structure and target that level.
Now, is this sort of discretionary part of the system? Because I'm learning too as we go along. In this system, the discretionary part, obviously discretionary being something that's up to your judgment. In this system, the discretionary part is defining that structure. Am I right?
Exactly. Yeah. So this is the target. So I've connected the simulator here. Again, it's on MT4. For me, I use MT4. If you're trading view, that's totally fine. The point is you need to have some kind of simulator that doesn't allow you to see the future. So I've put this in line with this data over here. As you can see, it's 24th of January 2018. Here we are at the 23rd of January. So I can't see the future on this chart. Now let's go take a look at the day it forms, which is the 25th. So this is how that pin bar looks. Now, as we have made the rules, we want to enter at H1 structure and we want to target this green line. So the next thing I want to do is put that green line on this chart. As you can see, it's 1.2255. 22.55. So that's the target we're going to hit. Stop loss goes above this high, which I won't be making precise right now, but you get the point. Now, to me, this is the last bit of structure price has made before forming that pin bar. So that would be my entry. But again, if you are going to test like this, really define structure. To me, this is the last bit of structure before the price fell down. That's where I want to enter. In terms of entry, this is the last low that has been made before the fall down. That's where the entry is going to be. Stop at the high, and target is going to be that area. As you can see, it's well below 3R. So I can adjust it, put in another level, make it 5, 4R. And there we go. I'm not going to do this precise because then I have to measure everything, but just eyeballing it, you can see it's around 3.4 R. Again, if you want to do your testing, please be as precise as possible because these small differences can, in the long run, make a big difference. So let's go forward with this. We have now defined our stop, entry, setup, etc. Let's see if we
I'm getting a bit nervous, mate. It's actually quite exciting.
Yeah, so we got a fill over here. As you can see, the entry line, we got a fill, and now you just go forward and see if we get a, there we go, we had target. Go to the charts. So 1R, that's the statistical target, did get hit, and the outcome of this entry was around, what did we say, 3.4 R.
So a solid trade then. Definitely a longer term trade. And I think going back to what you said earlier about having this as a simulation, it's not actually something I've ever explored because I strictly only trade really very mechanical systems in terms of indicators, right? But if you're going to opt to trade in this discretionary way where you've got to define something within your own trading knowledge, define structure, define certain candlestick patterns potentially or whatever, you can't, the backtesting is not worth doing if you're just going to give yourself reasons why you would have taken a trade or you wouldn't have taken a trade according to the result. I mean, if you can see what's happened after the entry or the exit, etc., you obviously are going to have something in your mind trying to convince you that you would have been in that trade or out of that trade or whatever the case may be for that example. I think on TradingView you have something built in where you can reveal one candlestick at a time. You obviously got the same thing here with the simulator on MT4. So this is all so you don't skew the results, so you don't give yourself reasons to not enter a trade or to exit a trade or whatever the case may be. So to have this simulator in place to really not allow you to see what's going to happen, because you're looking at historical data at the end of the day, we already know what's happened, but we need to block that from our minds so we don't skew our results without even noticing it, because at the end of the day, it's only going to be exposed when you progress this forward to the demo trading period, and woe betide anybody who takes it to the live trading, because they're going to find out the hard way. Actually, their money's on the line then. So this is all in order to make sure we've got the most accurate and precise results. So I guess that's the whole reason why we're using this. But look at that trade, mate. 3.4R, that's a solid trade.
Yeah, that's a great trade. So one little tip before you're going to do this, please highlight all the setups on the daily time frame, because as you can see, here is not a valid setup that we now missed because we were simulating. But when you do this, first start with the daily, highlight all the setups, and now if you're going forward, you know, all right, on the 31st of January, I know there's not a setup, and then you don't screw up the results. But let's do another one. We are at the 8th of February. Let's see. That's over here. As you can see, the body is not above the half of the candle, so it's not a valid pin bar. If we look at this one, it is above, so this would be a valid candle. Again, it's the 9th. Oops, let's see. So we're now at the 8th. Let's go to the 9th, and this is that pin bar on the daily time frame. So the process starts again. We're going to put in the target based on the close and the low. Target is going to be 1R, 122.94. Let's remove, oh, that's a mistake. Yes, there we go. Let's remove the auto trade. Again, you on simulators, you can actually enter the trade. I don't do that because I just want to have all my data in Excel, but it's up to you. So as you can see here, stop loss below the low. There is no clear structure, and this is where it becomes very, very hard. So maybe you have a rule in your system that says if there's no clear structure, I'm just going to enter at the close of the bar. But again, that's up to you, and that's why it's so important to start testing, because during testing you will find out these things that, all right, maybe there's no trade here, or how am I going to approach this? In this case, there is no clear structure below market to use to enter in. So that's when you come up with a new rule, go back, test again, and that's how you go forward. But let's say we just entered here. There we go, 1R has been hit. So I'm filling in a yes and then a 1R. And that's just how you go and go and go. And like we spoke in earlier sessions, you want a decent sample size because otherwise the data is not reliable. And you also want to go back over a few years of data. That's usually the best approach to do so. One more example. Let's see if we can find one. As you can see, here is one clear pin bar following the rules. Wake 2 times as long as the body, candle in the upper half, entry on the close, stop loss below. 1R is over here, which is 1.2402. 2402. Let's go to that particular day, which is the 5th of March. There we go. This is that particular day. Stop goes below the low of that pin bar. And again, no clean structure to get a retest on, in my opinion. Again, it's totally up to you how you define it. But in my opinion, there's no structure to go long off. So I'm just going to enter and target hit again.
Look at that,
so
3 in a row. That's maybe there's something. This is the thing. Three trades is not enough, but let's say you do 10 trades, 20 trades, 30 trades, then you can start to get an impression of how things are going to perform. Obviously, it's all about having a balance between having a good sample size and not making sure you're wasting your time testing something that never worked in the first place. I've tested something before that wins the first 10 trades and then loses the next 20 or something like that. So you have to have a decent sample size, but make sure you've got a point that you say, okay, after 40 trades, after 30 trades, I want to make my first impression. Is it worth pursuing further? And obviously you can put it all to that. You can take it and do 100 trades with it if you think it's worth the time. But look at that, 3 trades in a row. That's a nice work. And definitely a solid start.
Yeah, so this is how you want to approach a system with a bit more discretion. So it's still systematic. We have defined a pin bar. There's no guesswork around it. We know what a pin bar is. We know what target we're going to do, which is 1R. Again, no guesswork there. The only bit of systematic discretion is where are you going to draw your structure. And that's where you want to make as clear as possible rules. So for me, structure would be structure below market before the candle forms. But again, up to you. And that's basically how you test a discretionary kind of approach. Again, please make sure you don't do any hindsight stuff. It's just going to be a massive waste of time. This is, in my opinion, the right approach to test the system with a bit of discretion. I'm sure there are a lot of different approaches out there, but this is how I used it back in the day. I'm more a fan of this. I really like the mechanical approach, but I have tested something like this in the past and it gave me great results. So that's definitely something you want to do. These are the two systems. If it wasn't clear, please leave a comment down below and we're going to help you out there. But these were the two systems I wanted to show you.
All right, so that was a little bit heavy. There's a lot of information to be absorbed. Don't feel afraid to go and rewatch something if you don't understand it already. And also, as Cass just mentioned, drop us a comment down below. Both me and Cass are ready and standing by to help you with any questions that you might have. So definitely get involved if you want to have anything answered. And also drop some comments down below for further suggestions. I'm sorry to say we've got one more episode left of this series where we're going to tie everything together and really round things off. So if you have any suggestions or any questions you'd like answered for the next episode, you know where the comment section is. So comment those down below. As always, we're going to do a bit of a recap now and a preview to the next episode. First things first, check your rules and see if they are clear enough to test, like we just did, like Cass just did in fact. Now, Cass kind of took the reins with the charts, but this is all about defining those rules. We took you across two different approaches, okay? We took a mechanical approach and we took a slightly discretionary approach in terms of discretionary meaning that you have something up to your judgment, but you need to be consistent within that rule. If you have to judge a level of structure, then you need to apply that same rule, that same set of standards to be met to define structure for every simple example in that backtesting session. So make sure you got rules that are clear as they possibly can be to make your backtesting as simple as possible. At the end of the day, if you're going to confuse yourself, if there's some sort of conflict of information, it's only going to skew your results. And at the end of the day, backtesting can take some time. I won't pretend to that it doesn't. It's definitely worth doing. You can get a lot of experience, knowledge, and you can improve your trading tenfold if you actually take this seriously. But if you have certain things that skew your results, it's a complete waste of time. So if backtesting is going to take a long time, then we might as well make sure we're doing it properly. So at the end of the day, when we finish our days of backtesting, we can look back and say, I've actually gained some value from doing this, as opposed to just hindsight trading and having very inconsistent rules within your own trading. Right, the next point. Start backtesting, add filters, and gain an edge. This one's pretty straightforward. Start backtesting, you've got to take action, you've got to actually start doing something, get the ball rolling, and obviously you will gain experience, you'll speed up in time. So if you're painfully slow at doing this at the start, so was I. I'm sure Cass was definitely sped up in this as well. Start backtesting, get started, get the ball rolling. When you've got something that looks promising, start adding some filters, start adding a combination of indicators together, start adding some confluences together. Start adding things that may or may not improve that concept. As you know already, sometimes you put 1 and 1 together and it becomes 3. So understand that if you've got something that's promising, the possibilities are endless, and you can add further filters to that to gain an edge, to gain that advantage over other traders in the market. Because that's what an edge is to me. It's about gaining an edge over other traders. It's about having something that's unique to yourself that allows you to boost your trading performance. And that can be a combination of different concepts that you've tested. As I say, put some things together sometimes, they equal more than the sum of their parts. And last point on the slide, next video. It's the last one, as I mentioned. It's going to be a bit of an emotional one for me and Cass. It's demo trading, it's live trading, and journaling. All very important steps. I think the backtesting phase is going to be really the meat of this whole process. I'm still backtesting, and I've been doing this for years. Now, it's not to put you off, but to understand that there's always further improvements you can make to your system. Now, when you push something through the demo trading phase, you need to be very, very sure that it's actually something that works. And that all comes down to how you backtested, the confidence you have in your system. And that's the thing, as we mentioned, I think one of the very first episodes, it builds confidence. When you know that a system works through many, many hours of rigorous backtesting, you can be much more confident and much more able to stick within the rules of your system. So that's something to be aware of as well. Demo trading is the next phase, and if you haven't done this period properly, you're only going to be exposed to yourself within demo trading. You're only fooling yourself at the end of the day. And as you say, if you move forward to the next stage, to live trading, then you actually got real money on the line. Journaling, something we haven't really touched on this series so far. Journaling is all about taking account of each trade, recording it down, pen and paper style, old school, in a spreadsheet. Like we always talk about spreadsheets on this show. It's about recording your results, maybe taking some notes down, something a little bit more personal, not just so much data. That will be covered next episode, so definitely stick around for that. I think that is it for the slide cast, isn't it? Let's move forward.
Yeah, that's it.
Cool, man. Let's wrap things up. Cass, I appreciate you taking the reins today. You obviously know a lot when it comes to the chart, so I appreciate you taking care of that. I think that hopefully has allowed you to sort of tie things together, has allowed everyone who's watching to sort of understand a little bit more how you apply everything we've learned you in the first 4 episodes leading up till now. As I said already, any questions, you know where the comment section is. Show us some love in the video. Like, subscribe, and notifications on. There's plenty more content coming like this on the way. And speaking of content like this, I know a place where there's lots of interesting and educational content that you cannot afford to miss. That is 𝗯𝗲𝗹𝐻's channel. It's CDFX Trading. It's always the top link in the description. So go and check that out. Show him some love as well. He's got a lot of amazing content on the way. So definitely go check that one out. 𝗯𝗲𝗹, do you have anything to say?
Well, good luck everyone with testing, and make sure you get started. And then I see you in the next session, because that will also be very interesting, especially the journaling part, which sounds very boring, but is very, very easy to do and is very handy to do. So please stick around and subscribe, of course, because you don't want to miss that session.
Perfect, guys. Take care, and we'll see you soon.